Hey folks, this is Clayton Collins, CEO of HW Media and your host for the Housing News Podcast. I literally just got off a plane and came into the HousingWire office here in Dallas, Texas to record the intro for today's episode. I've been out in San Jose, California at the Mortgage Bankers Association Technology Conference all week. And on the back end of MBA Tech, I couldn't think of a more appropriate episode to drop than my interview with Matt Rocco, chairman of the Mortgage Bankers Association and also president of Colliers Mortgage. In today's conversation with Matt, we talk about how quickly the market is changing and how that impacts banks, both depositories and mortgage banks, and how that flows through to impact on loan originators. We take a very holistic view of the residential housing market. Given Matt's strong background in multifamily and CRE, we like to take an approach that connects what's happening in the rental market and how that impacts and relates to what we're seeing in the single family homeownership market. And finally, we take a look at current CRE outlooks with specific consideration given to the impact on small U.S. lenders and some of the news that we've seen in the market about GSE credit loss preparation. I hope you enjoy this episode today with Matt Rocco, chairman of the MBA and president of Colliers Mortgage.
Hi, this is Sarah Wheeler, editor-in-chief of HW Media, and I'm talking to Ed Messman, CEO at Rook Capital, about their shared value investment program. Ed, how is Rook Capital creating new homeowners?
Yeah, the shared value investment that we created helps prospective new homebuyers by adding up to 25% to their down payment in exchange for an equity position in the house. By doing that, you effectively lower the monthly cost of homeownership to a level that's affordable and within their budget.
Thanks, Ed. And listeners can find out more at rook.capital.
I heard there's a car company that actually is like working on self-driving, where if you like miss a payment, the car just returns itself.
Okay, and that's scary too. But back to the priority of payment. I mean, we're now challenged. Years ago, before the GFC, as you know, Clayton, a lot of people would pay their rent or pay their mortgage because there were no alternatives. But instead, we've come to a point for which if you take my car and you take my phone, I can't live anyways. I got to get to my job to pay partial rent or partial mortgage payment. I need a phone so I can communicate with my boss or my family, my caregivers or things of that nature. So I think we're really going to test that. And some of that introduced through forbearance during the COVID crisis. And I think that's going to be a real interesting intersection of commitment and financial ability and willingness to support credits. More so focused on the residential side. On the commercial side, most of the loans outside depositories are non-recourse. So it is quite frankly, a bilateral agreement to say, I'm going to make my payments until I don't want to make my payments anymore, and then I'm going to give you back the keys and you can foreclose. And there are asset classes, most notably office, that are going to suffer that fate as a result of equity investors saying, it doesn't make economic sense for me to feed this beast. I'm not going to get the return. It's not likely I'm going to see the value, not just in my investment holding period, but before the asset is actually functionally obsolescent as well. We are going to test all of those, not just because of the cycle we're in or the 0% interest rates that we're coming out of, but because this business cycle now driven by a combination of all those effects and forces are going to drive this to occur. And there will be losers. And, in banking, we really did test what a SIFI meant when you're, running around with First Republic and then SVB and what have you. And it's going to be very interesting to see how far that waterfall flows down to the consumer. Testing the mettle of will we have forbearance programs and economic disruptions? And what if, we have all these office properties and the banks, although their CECL requirements require that they dispose of the note, they're actually impairing not just their balance sheet, but the markets itself by, pushing back some $80 billion this year in commercial office loans that are going to be TDRs and or in default or whatever. Those are the things that are, quite frankly, new territory for the market. And I think we're going to need to be we're going to need to quickly adapt to those changing market conditions so we don't make a bad situation much worse.
It all comes back to those fast changing market conditions. So as we're talking about your capacity of chairman at the MBA, in relation to the constituents, I've always given a lot of thought to the fact that I don't think the resi mortgage folks pay a lot of attention to what's happening in the CRE world. How closely are the CRE constituents, specifically multifamily, kind of paying attention to the single family residential market? And are there certain data points or trends or dynamics that they pay the most attention to that might influence their investment theses or feelings on the market? Because we do know that rental housing is often a stepping stone to owning property and moving into that owner occupied property. But we've also seen trends in the last few years of more people choosing to rent versus choosing to rent as a stepping stone. So I'm kind of curious of how that owner operator investor, those constituents on the multifamily side think about the single family owner occupied market and how much it influences their thinking.
They most certainly do, because you're right. In the continuum of housing, they want to know, will good renters sometimes hopefully become good homeowners, and what does that look like? I think some of the work both agencies have done under the direction of FHFA and credit counseling and support and things of that nature are quite positive for the marketplace today in building not just better renters today, but better homeowners tomorrow. But in the commercial multifamily space, no doubt, the safety and soundness in residential is key. It is ensuring that there are safe, decent, and affordable housing in markets that provide stable communities. And, that means you're in the commercial space that your workers have a place to live. It means that your retail centers, have, if you will, clients close by that with, that type of housing, low crime rates and good schools, and go down the list of all the things that matter that really are impactful. In the apartments to the single family specifically, however, though, it's just that building block. It is understanding, when demographic changes occur, who will be the winner? Will it be the residential side and the single family side? Well, supply is hard to come by, difficult to build, and without true incentives, I don't know that there's going to be a lot of economic opportunity to meaningfully add new supply to the marketplace to deal with the affordable housing. And then also with the demographic changes, younger folks today change jobs every 3 to 5 years. And I think we're going to test that again, particularly in this market with associated downsizing and recalibration companies need to take with their workforce, work from home, and a whole bunch of other things that will have to play themselves out. And of course, that's a direct impact on the multifamily side. So I don't know that they're always attached at every touch point of the capital markets side, but they're absolutely congruent. And both sides would be cheerleaders for the others in stability, safety, and soundness.
Yeah, according to Altos Research, there's less than 425,000 active single-family listings right now, which by our measures tells us there's a massive supply-demand mismatch, and we don't have enough single-family houses. Do multifamily operators, investors kind of read that as a positive signal for demand on the rental side? And it feels kind of counter to the fact that it feels like we're seeing rent growth slow and seeing softness in the multifamily market. So it feels like would be anticipating those two things moving against each other, but it's like, I don't know. How do you read the relationship between single family inventory and rent growth?
Both trouble. A lot of the multifamily deliveries that we've seen in the last few years have been in the Class A space. And over the next 24 months of the 900,000 units, I think it's like 75 or 80% are again in that Class A space. So there's, a crowd there in what happens when a market is overpopulated, rents decline, concessions kick in. But it actually, in defense of the developers and investors in that space, they had no other choice. Land prices were high, interest rates were low. So, asset values grew and you needed to, build luxury to get the rents. There was still positive wage growth and, a number of other things that kind of drew that. Now that is very attractive. And certainly the rental housing in the multifamily space, investors know and appreciate that. But again, I'm challenged right now to tell you that there's a lot of markets where it makes sense with today's inflation still in some building costs, high land prices, labor shortages, particularly for certain trades, where it really makes economic sense, to your point of decelerating rents, increasing expenses, and a number of other things, to put shovels in the ground, a further wet blanket on supply. So it's really tricky out there. I would characterize the commercial multifamily space as a bit of stagflation. Operating expenses are up, building costs are up, permit costs are up. G&A, taxes, insurance go down the list. But in fact, rents are stable to declining in some markets. While on the single family side, it is still exceedingly expensive to build. There's a lot in not in my backyard syndrome still out there. We have some federal support for increased affordable housing. We really don't have it, practically speaking, at the state and local levels to really make a difference. And just, the math says where the deficiency in single family homes is this much, but you can't cure that specifically with the residential side just because of household formation and growth and a number of other things. So it's going to be really tricky for a while to positively intersect those two. And it likely, unfortunately, is something that we'll always be working toward because I don't see a balance to that probably in my business lifetime.
Yeah. And I think the dynamics that encouraged or required luxury development on the multifamily side are also impacting the construction and new home construction and single family. A lot of the builder incentives are pushed toward creating luxury or higher end homes. The starter home is not exactly a business model that works right now. And when you hear some of the commentators and pundits and folks talk about solutions to bringing more inventory to market, one of the ideas that was really popular for the first few months of this year was taking all of these empty office buildings and converting them to residential. I have my views, but let's hear yours, Matt. Do you think we're going to see a massive reconversion of office to resi?
No, nor should we. They don't make economic sense by and large. Let's take the population. And I would say of the total office population of the $4.5 trillion commercial real estate marketplace, office represents about 30%. That's a lot. It's a lot of inventory, and much of that inventory is actually functionally obsolescent or Class B or below. A number of things that make it more challenging just to upfit. But that doesn't mean that conversion is the answer. Because think about the floor plates in office. I mean, you actually need windows in residential. You need bathrooms. You need, go down the list of just common sense of what you need in residential, even in SROs or affordable seniors housing or whatever. You need these things that come at a premium to convert. So I think at some point, some of the inventory that people are talking about, and it sounds good and it's very interesting to talk about it, but you're talking about that 10% true population that makes sense to convert. And I think they should. And I see opportunities for affordable housing, workforce housing. I see opportunities for vocational training and mixed use developments. But again, it's a de minimis part of the overall landscape. And then on the balance of it, quite frankly, and I've said this throughout my career many times, office is characterized as being overbuilt. And I would submit to you that it's just under destroyed. It needs to go away. It does not make sense as an office building anymore. Now, what does it make sense for? That's for the investors to decide, but you're going to see asset values go from those functionally obsolescent buildings from $1, if you will, to maybe 20 cents, maybe even less. And there are going to be lenders who are just like, gee whiz, do I really want to own an asset for which you need about 70% occupancy to break even, having to give concessions? I don't know if there are enough not-for-profits out there and if you will, worthy local causes who can pay just a little bit in rent to support even the operating cost of this asset. Well, insurance is very expensive. It even gets more expensive when buildings are unoccupied, interestingly enough. Taxes are still up there on a relative basis, water, sewer, go down the list where inflation still exists in a meaningful degree. They make no economic sense.
Really interesting. So under demolished, that is an interesting concept. And when that time comes, and I don't know, do you think the barriers to that time are right now the owners of the assets, or is this municipalities that are kind of blocking these rebuild projects, not conversion projects?
I wouldn't blame it on the government at this point, really. I think they're separate. I would submit to you, though, it is the owners, ultimately, perhaps even the bondholders or the B-piece investors or the special servicers that actually force this to occur. And I'll use that term specifically, force. But it's the maturities, Clayton, that is the catalyst for this. Because many office buildings, actually, even some of those that I've described as, being, functionally obsolescent or even, moderately economically viable, are still positive debt coverage. So the investor is not going to default on that until they have to put new capital in the transaction. But when that occurs, and it's usually at a right sizing at maturity, with a decline in asset value, the old falling knife expression, investors likely will say, well, what do we need to do? And for a vast majority, those asset values need to decline. It's not the 30%, it's the 60% until you get to some point of either regentrification or alternate use or adaptive reuse or things of that nature. But you need to reset the values for that to occur to have any economic upside.
Interesting. So Matt, as we wrap up today, I want to come back to a question about your role as chairman of the MBA. So there's a set term for this position, correct?
Yes, 1 year.
It's a 1 year term.
Chair, and then on the ladder, there's 1 year in each as a vice chair and chair-elect.
So as you kind of look forward to your time in the chair role and then your time as chair, post chair, what does success look like for you? What do you want to accomplish in this period where you have an opportunity to make an impact on the industry?
I'm glad you used that word success, because I do think it's important to define success. Otherwise, you'll never know if you're on the road to achieve it. So what we did is we mapped out a strategy for affordable housing. And this is building upon some things that my predecessor did, Susan Stewart, in building generational wealth in homeownership, and Christy Furco in the Home for All pledge, and then my commitment to affordable housing in the rental space, but also the rental space, which does include single family, as you might expect. And it's really, again, that leadership continuum of being able to recognize that affordable housing challenges, not just Big A, but workforce housing, is going to be critical, not just to the communities which we live and work, but ultimately the country. I think there's so much at stake. So my commitment today is to break down the barriers, to meet with legislative leaders, to meet with regulatory leaders, whether it's FHFA, whether it's state and local governments, or even at the federal level, to find ways that we can, I would say, reduce the silly barriers that prevent us from putting needed new supply through density bonuses, public-private partnerships, tax-exempt or structured bond products to the marketplace. Much of that, however, though, Clayton, is building upon existing policies that exist that really just build upon, for example, an opportunity zone concept for spot opportunity zones. I think that there are things that we can do in the local government in some housing developments that require curbs and gutters. Well, I'm sorry, but everybody likes them, but do we really need them at the cost of that? When we look at what it costs to develop both single family and multifamily, and 35 to 40% is associated with impact fees, regulatory guidance, and some of the things local to municipal and state governments. I'm not suggesting we can eliminate all of that, but even if we cut it down 30, 40%, if we were to do that in a public-private partnership or through investor-developer models, that creates supply. Supply in and of itself presents opportunities. So I think that that's what I want to do today and throughout the balance of my term as chair. But that commitment is unwavering, Clayton. So that will go on post-chair and my role on the board of the MBA and other trade organizations, because I really do believe it's one of the biggest challenges facing our community. I mean, if you don't want to deal with affordable housing in your backyard, you really won't like homelessness in your front yard. And we have, unfortunately, cities around the country that are facing that today. And I'm not going to get into the blame game, whether it's political or whether it's, environmental or local or what have you, but it's probably all the above. And what we need is dedicated leaders who will break through that and really make sure that people understand having affordable housing supports stable communities. I would say positive matriculation for people in communities to advance and be part of, a greater share of the American dream, while at the same time reducing crime and creating greater economic opportunities, property values, and I think that goes a long way to what we all want. So that's a long answer, but it's not going to change, and I expect to be doing that even in my retirement, because I'm committed to do so. And I've been very fortunate to be a part of industry trade organizations like the MBA and others that have granted me privileges to do that in concert with them.
Well, Matt, I want to see you be successful in this mission. So please let me know if there's anything we can do, I can do to help. I think really appreciate this dynamic conversation on the built world, real estate across different asset classes. I think the relationship between office and apartment and multifamily and single family residential is fascinating, and something that doesn't get enough conversation about the interrelatedness of the assets and the loans. So thank you for helping shine some light on these relationships.
Well, absolutely my pleasure. It's an honor to be here, and you reach out anytime. Otherwise, just keep the good work you're doing, informing consumers about what the opportunities are, but the challenges as well, and then bring together a group of thought leaders to help think through those and see what we can do to affect positive change.